All right, welcome to part 3 of our case study, a real-world case study on what happens when your spouse dies from a tax perspective. So remember, we had Betty and Joe, we'll just call them, and Betty's a real-world person. I was just working with her just the other day. And what happened was Joe died in April of 2018. All right, so we did the tax consequences for her throughout the end of 2018. And remember, she's still married filing jointly. She will be married filing jointly as a taxpayer for the end of this year. Next year, she will be a single taxpayer, or a widow. It's the same thing. Single and widow are the exact same thing. The CPA was saying you shouldn't really do anything, and I completely disagree with that, simply because the tax brackets are so much more beneficial for married couples than they are for single people, especially if you're taking Social Security. So we just did a study where I showed you the tax consequence, the difference in taxes for her versus married filing jointly, and I'll show you again. When she's married filing jointly, just with Social Security and the pension, she had negative $200 of taxable income. When she was a single taxpayer, just with Social Security and pension, she had $15,000 of taxable income. All right, so she had over $15,000 more of taxable income, even though her actual income was $5,000 less. So that's a difference of $20,000, my friends. Taxable income more than $15,000. Taxes in this case was $1,618, again on $5,000 less. Taxes when she had $5,000 and more and married filing jointly was nothing. That right there, part and parcel, is the difference in tax code between a single taxpayer and a married taxpayer when it comes if you're on Social Security. Then we showed you what happened if she did a Roth conversion while she was in 2018, while she's still married filing jointly. And it made her taxes go up by $1,618, even though she only did a $10,000 Roth conversion or an IRA distribution. Doesn't matter what you do with the IRA, put it into a Roth, take it out, it doesn't matter. But because she had a $10,000 distribution, it cost her $1,600 in taxes. That is an effective 16% effective rate on that $10,000, even though she's only in the 10% bracket or the 12% bracket. Doesn't make sense. But again, married filing jointly, even though she's only in the 10% bracket. So she had an effective 60% tax increase on doing the Roth conversion when she's married filing jointly, simply because of the way the tax code is structured when you're taking Social Security. So now we're going to do what happens when she does a Roth conversion as a single taxpayer, or again, just an IRA distribution. It can be for whatever she wants. She could put into a Roth. She could light cigars with $100 bills. I don't care. It doesn't matter. Doesn't have to be a Roth. Just has to come out of the IRA. What happens to her tax consequence now? So let's take a look. As always, the first thing we got to do is we got to figure out our provisional income. All right, so what you do is you take all of your, you take your half of your Social Security, half of your Social Security, plus your pension, plus in this case the IRA distribution. So we take pension, IRA, and half of that Social Security. That is their Social Security benefit, $1,700 a month. So I don't know what that is off the top of my head. I don't have the brain to figure that out. So I got to say her half of her Social Security is going to be $10,200. And we add all this together. So we have 10, 34,000, 44,200. So quick quiz. Why are we calculating provisional income? Because provisional income will tell us how much of our Social Security benefit is subject to taxes. So when you're figuring out your taxes, if you're in Social Security, it is a two-part code. You got to figure out your provisional income to see how much of your Social Security benefit is subject to tax. And then you got to figure out your adjusted gross income to see what your taxes are. It's a two-step process, and a lot of people miss the first process. They just look at their AGI as a combination of their Social Security, the pension, and other income. That simply could not be further from the truth. So in this case, we have provisional income of $44,200, but we got to figure out what our taxable amount of that is. So for a single person, So in this case, between $44,000, the first $25,000 is tax-free. The next $9,000 is taxed. 50% of that is taxable, which is $4,500. Now we got to figure out. We have $10,200 that's going to be taxable at 85%. 44,200 minus 34,000 is 10,200. And again, I need my trusty calculator to see how much that will be. 8670. And we got to add those two together. 8670 plus, that's 13,170. That's our taxable Social Security, 13,170. So let's keep going. Let me dip my trusty spray. Now we got to figure out AGI, our adjusted gross income. And we take our trusty spray. 13,170. 13,170. So I can remember that. Taxable Social Security, 13,170. All right, 13,170. All right, so we take 13,170 plus our pension, 24,000. Uh-oh. Uh-oh. Plus our $10,000 IRA distribution. And this is what we have to do to figure out our AGI. So here we got 37,170 plus 10,000. $47,170 is our adjusted gross income. Now we got to take our standard deduction. So if you're a single, you actually have a little bit of a bonus on a standard deduction if you're over 64, 13,600, not 13,300. Now we got to take those numbers and we got to subtract those from each other. So I take my trusty calculator. We take 47,170 minus 13,600. 33,570 is our taxable income. I'm going to write this over here. Oops. And the first thing I see, without even looking at it too closely, I said, whoa. All we've done differently is take a $10,000 IRA distribution, and yet our taxable income has increased from $15,070 to $33,070. How could that possibly, under God's green earth, be where I take $10,000 more as income, but my taxable income increases by $18,000? That doesn't make any sense. Welcome, my friends, to the tax code. When you're on Social Security, taxable income, $33,570. All right, now the first, $9,000 is taxed at 10%. Let's say $9,500. Which equals $950. So subtract that minus that. Next, $24,070 at 12% times 2888. Add these two together, and we get 950. 3838 in tax. So let me clean this up and we'll go over it. So, from taking a $10,000 IRA distribution, regardless of what you do with the money, you're going to take IRA distributions out regardless, because at some point you're going to hit RMDs, required minimum distributions. Her taxes went up from 1618 to 3838. So 3838 minus 1618. Her taxes went up by $2,200 on a $10,000 IRA distribution, an effective tax bracket of 22%. But she's only in the 12% tax bracket. How could that be? Because her taxable income went up from $15,070 to $33,570, because not only does the tax code change your taxable income, it changes how much of your Social Security is subject to taxes as well. So let's go back and compare these two and wrap this up. When she's married, filing jointly, and all she had was her Social Security and pension, she paid no tax. When she was single and all she had was her Social Security and pension, she paid $1,618 tax, even though she had less income. Even though she had $15,000 of more of taxable income, even though she had $5,000 less in income. That's just a fact. The difference between the tax code in a single person and a married person. No other way around that when someone's on Social Security. When she's married, filing jointly, to take advantage of the tax code, to take $10,000 of the IRA while she's married, filing jointly, that increased her taxes by $1,612, even though she's only in the 10% bracket. So she paid 16% effective tax rate on that $10,000 distribution, which meant her taxes, again, were $1,612. When she was a single taxpayer, and she did the same thing, it increased her taxes by 250%, from $1,612 to $3,838, because now that's $2,200 more, right? Yeah, $2,200 more. So her taxes went up 22%, even though she's only in a 12% tax bracket, due to nothing more than the fact that she's single. Her taxable income is $33,570. Again, an $18,500 increase in taxable income, even though her income only went up by $10,000, and thus her taxes went up by $2,200, even though she only took a $10,000 distribution out, even though she's only in a 12% tax bracket. That's it. When you are married filing jointly, you want this, $1,612 in taxes. You don't want this, $3,838. Yes, did you have to take an IRA distribution in this year? No. Will you? Yes. There is something called required minimum distributions. Take advantage of the tax code while you're married, for the love of me. I cannot stress this enough. People who don't are still going to have IRA distributions, and when they are on Social Security, which they will be if they have mandatory distributions, it's going to affect their IRA, their income tax, plus it's going to increase their Social Security tax as well, which means a $10,000 distribution will increase your taxable income by $18,500. The proof, my friends, is right there. Dispute it, pretend it doesn't exist, but now you're aware, and now you know what to do. Take advantage of the married filing jointly tax code. Any questions, thoughts, concerns? Put them in. This is a real world study. This is a real case. This is really somebody I was working with on Tuesday. This isn't pretend. This is real world. Don't forget to subscribe. Thumbs up always help. Comments, questions, concerns, always welcome. And of course, as always, go to the blog at heritagewealthplanning.com. We'll see you next time. Thanks, guys.